Hey there, macro folks. This is Mr. Hooker, and today we are going to talk about monetary policy, which is basically done by the Fed. It is the use of interest rates and any other monetary tools to alter macroeconomic outcomes. So let's look at this. What do we have? So, opportunity cost of money, of holding money. So we all carry some cash for convenience. Probably in today's economy, we all carry less cash than we used to. But there's an opportunity cost of carrying that cash. So cash yields zero return. So we give up the interest that could have been earned by putting that money into interest bearing assets like CDs, savings, things like that. So a CD is a certificate of deposit and allows you to deposit funds for a specified amount of time and earn a specified interest rate. It's basically high interest, high rate of interest, but it locks your money up. So if you withdraw before the time is up, they hit you with all kinds of penalties and fees, and banks love them. Customers, maybe not as much, especially like younger folks don't use them as much nowadays. It's kind of a thing. So individuals and firms trade off the benefits of holding cash versus the benefit of holding interest bearing non monetary assets. So a 1 month T bill has an interest rate as of February 23 had an interest rate of 4.51. Interest bearing demand deposits, so basically like now accounts, zero point 0.1, which is terrible. And then currency gives you nothing. You will take nothing and you will like it. Funds in your demand deposits are more accessible than those in T bills, but they are only earning 0.1%. And that's on an annualized basis. So just note that's terrible. The most accessible asset you have is cash, and it earns nothing. So your short term interest rates are your interest rates on financial assets that mature within less than a year. Long term interest rates on financial assets that mature a number of years in the future, 3 to 5 years in the future, kind of thing. Um, the higher the interest rate, the higher the opportunity cost of holding the money. So you're going to get higher interest rates on long term assets, but that means that whoever has it is pretty much assured that they're going to have your money for a longer time frame. So that's the way that goes. Um, so that's why they pay a higher interest rate. Demand deposits pay a very low interest because you can pull all of your money out at any point in time. T bills are usually 30-year, and so they're paying a little bit more in interest. So your opportunity cost of holding money declined sharply between 2019 and 2020. Imagine that, COVID, right? So look at this table. Federal funds rate in 2019 was 2.41. 2020 after COVID, like 1 month into COVID, 0.65. 1 month T bills, 2.45, and then 0.37. Interest bearing demand deposits, 0.06, still 0.06. Ain't nothing changed there. Cash was still zero. Treasury bills minus interest bearing demand deposits and points went from 2.35 to 0.31. T bills minus currency went from 2.41 to 0.37. Ooh, ladies and gentlemen, took a beating. All right. So your money demand curve shows the relationship between the quantity of money demanded and the interest rate. So basically, at high interest rates, there's not going to be a whole lot of money demanded. And this is why this thing slopes down. A higher interest rate reduces the quantity of money demanded. Lower interest rates increases the quantity of money demanded. So we've got a downward sloping to money demand curve. So what shifts it? What are the things that might shift this thing? Changes in the aggregate price level. So higher prices mean we need more money for transactions. Low prices mean we don't need as much. Real GDP More goods and services produced and sold mean we need more money. Credit markets and banking technology. The ease of credit cards reduces the need for cash. So you're using plastic instead of cash. Also, the ease of like debit cards and stuff like that when you're using those. And the kind of thing about that is we also assuming that there's no fees with those. So if they start charging fees, people are going to go with cash more, and that becomes a thing. So, um, so anytime they're going to fee you up, people will change their behavior because people will avoid fees. Changes in institutions. So banks weren't allowed to offer interest on checking accounts until 1980. When that regulation changed, banks started paying interest on checking accounts, which raised the demand for money and shifted the curve to the right. So there have been a ton of changes just in my lifetime. And note, I worked in banking for about 3 or 4 years while I put myself through college and grad school. And there was a bunch of changes even in that time frame. That was the late 80s, early 90s. So that's just a way that that actually works. So just like every other demand curve that we've had in this class, if it shifts to the right, it's an increase. If it shifts to the left, it's a decrease. Okay? Right, increase, left, decrease. Never a doubt. So, how does the Fed control interest rates? All right, so understand the target rate for the Fed is not one of its administered rates. So, we talked about administered rates in the last chapter. It is not one of those administered rates. That's not the target rate. The target rate for the Fed is the federal funds rate, which is technically a private rate between banks. So this is just like, hey, I need to borrow money. So one bank looks at another bank, at the end of the day and says, hey, I'm going to need to borrow about $500,000 overnight. And it's always just overnight. So there's a little paperwork that changes hands. Really, no money changes hands. It's just a piece of paper that is faxed back, that is faxed. And it says that, hey, they have 500,000 of my money and they're going to pay me back tomorrow with interest. And here's the stated interest rate and it's the federal funds rate. So that is the target rate for the Fed because that is the interest rate used. Sorry. Um, so that is the interest rate used most by people. So by banks, and then banks base all the interest rates that they charge people for that off of that. So that is the way that works. So that'll go that way. Um, so we can influence the money supply through open market operations, discount window, reserve requirements. Not anymore. So those three tools died in 2008. I got a whole nother thing for you on that, but those three tools have not been used since 2008. Welcome to 2025. Okay. Um, so we're gonna treat them like Bruno, and we just not gonna talk about them. Equilibrium interest rate. So this equilibrium interest rate here, we've got a money supply curve. So money supply is a vertical line. There is only so much money in the economy at a given time, right? So we print the Fed, it's not really the Fed. The Treasury prints money, the Fed distributes money. Those are the two roles, right? So the Treasury prints it, the Fed distributes it, they send it out to the banks. We're good, yay team. And that's the way this all works. And then we go with that. So that is all of the money that we have out there. So the Fed chooses a money supply. So the Treasury may print a bunch of money, the Fed may just not send it out. But they will send it out over time. So that's your money supply, that's your vertical line. And then the interest rate happens at wherever we are with where money demand hits that money supply curve. So this is basically what the Fed is doing. So they are adjusting that money supply left and right to hit that money demand where they need to hit it, and that'll adjust uh, some of that whole thing too. So they use a couple of different tools. One, they're using money supply, and two, they are using money demand by adjusting interest rates. So we've got a couple of things going on with that. So suppose that an economy's aggregate output level increases, assuming the central bank does not engage in monetary policy, which of these statements is true? Interest rate goes up, interest rate goes down, interest rate will be unaffected by this change. Change in aggregate output causes a movement along the money demand curve. No. So looking at that first one, there it is. Interest rate goes up. All right. So by adjusting the money supply up or down, the Fed can set the interest rate. And that's what I was just saying. So if you move that money supply left or right, you're really kind of messing with that interest rate, assuming that money demand stays constant, right? So if money demand is constant and I am the Fed, I can move money supply left or right, and that will change interest rates. So the Fed sets that target federal funds rate, undertakes the appropriate open market operation, and targets that federal funds rate. And so what they have, I mean, they don't have like an exact target for the federal funds rate. What they have is a range. It's a 0.25% range. Last time I looked, it was 4.5 to 4.75. Might be a little higher now. So that is kind of the way that goes. So they've got a quarter point range, um, a, a quarter% range that they want that to be in. And so that they can, so there's some flexibility. They're not like iron fisted on that, but they have a little flexibility, just not it's not terribly bad. So, so there's your money demand, your money supply. We're going to hit it at M1, rate one. We increase it. Oh, come on, Hooker. So if we increase it, your interest rate would fall. They just don't give me a second piece to show you that. So I don't have another line to show you, but you could see that it would decrease the interest rate. All right. So if I were at M1, R1, and then I move it to the right, I'm at equilibrium 1, R1, but that's a lower interest rate. So, you know, that's kind of a thing that you're going to do. Um, that's just you know, kind of the way you're going to run it. In this one on the left, we're going to need to push the interest rate down. And the one on the right, we're going to have to push the interest rate up. So there you go. We are at R1. We're going to increase the money supply, and that's going to push the interest rate down. Over here on the right, we're at M1, R1. We're going to shift the money supply to the left, and that's going to raise the interest rate to RT. Okay, so that's how that works. That's what that's going to do for us. So moving that money supply, that's one of the big tools in the toolbox for the Fed. They can do that. They do it in weird ways now. It's interest on reserve balances, um, the administered rates, and forward guidance mainly. So suppose the money supply curve shifts to the left. Most likely cause for the shift is the open market purchase or sale. So basically, they're taking money out. And in that case, it is the purchase of T-bills. Um, excuse me, sale of T-bills. Excuse me, sale of T-bills takes the money out. Purchase, they're given, they're giving money to the banks. If they sell T-bills, they're taking money from the banks. The banks will have T-bills, and the Fed receives money. All right. So we will start here, right here with Uncle Sam. on our next video looking at long-term interest rates. We will see you in the next video. Take